What's up, guys? It is Friday the 12th, round two on our recording here, because I don't even know what damn day it is. It's been that freaking crazy this week. So we've got a few things to talk about. But number one, I'm going to introduce you guys to Scotty Bear. Scotty and I have known each other 20 years, actually over 22 years now, I think it is. Right, Scotty?
It's pushing up there.
Yeah, it is. It's starting to show that there's some age between these two sumbitches here. And we've got... we were working together, started out at an outfit called North American Mortgage way back in 1999. Then quite a few years together at Countrywide. Then you had 2008 happened. We got taken over by Bank of America. That was like serving time for a crime we didn't commit. So we both separated, went different directions. And we ended up back here together. Scotty reached out to me and now he's with me. So you guys will hear from him and talk to him a lot about rate. Because when I'm chasing around doing what I do, he's licensed in all the states I am. He's locking rates. He's talking to you through this. He's an investor himself. So I'll let him give you a little bit of his background.
My background starts with you, Countrywide. Took a little break from mortgage industry and back at it.
And 24 states. You also real estate, I mean, have real estate investments, right? So when you're talking to people, this is not something that's foreign to you.
No, I buy the properties for the properties. And at the time, the mortgages, they are what they are. A lot of people that I'm talking to these days, the first properties I bought, early 80s, I'm from Boston, Beacon Hill. Back then, I had two tiny little condos I was fixing up and renting. Back then, rates were 13, 14%, not because I was bad paper or anything. I had awesome credit. Just back then, rates were 13, 14%. So
what was the price on those properties?
What's that?
What was the price on those properties?
Back then, I think there were like 60, 80,000, probably $1 million today of properties that, I kind of fixed and flipped. But
yeah, so 60 to 80 grand. In reality, that's not far off a lot of the people we're working with. We're seeing people buying 80, 90, $100,000 properties. And they're really freaking right now about where we are with the market, what's going on with the interest rates. What rents were you getting back then on those properties?
So long ago, but
I would venture a guess probably less than what our people are getting today on these $60,000 or $80,000 properties.
I don't know. They're talking 30, 35 years ago, so too hard to remember. But at the end of the day, when people say, now that we've kind of come out of the threes and we're into the fours, when someone says rate seems really high, for me to go back when I paid first properties I bought 13, 14%, 4.25% is the closest to free money you're ever going to see. We're still really
especially when you're talking inflation right now, the inflation situation being what it is, you're under the rate of inflation when you look at true inflation. But I think the main thing we definitely want to jump into, and you see the market going on in your background there, what people are going to start freaking out about right now is this. And I wanted to show this and share this and get some commentary from you, Scotty, on what has hit our market yesterday. So actually, it was the day before yesterday, very, very late that evening. The US Treasury came out and they imposed additional risk criteria on the GSEs, meaning Fannie and Freddie, and they're now restricting them that they can only have, their entire portfolio can only contain 7% of it to go towards investors and second homes. That's a big damn deal, guys, because from what I understand, when I'm looking at the data that I continue to monitor and talking with our secondary marketing folks who interact with Fannie and Freddie, from what I understand, Fannie and Freddie right now are absorbing about 10% of the market was investment loans before. So that's 10% of the market was investors, right? So if that's what it is, and now you're lumping investors and in vacation properties into this, and they're trying to keep it to 7% and be 93% owner occupied. That's 30% of just the investor piece of it has to try and find a new home, right? So I have no idea how this is going to shake out. One thing I know for a fact, is that the market works itself out. Now, go back a year ago. What we're going to do is we're going to pop away from this article, look it up. You can do the search for Fannie Mae tightened standards on investment properties. Look for the Housing Wire article. I've got it all right up in here. Check that out, see what you can see there. We'll get more information for you to explain what's going on. Scotty will talk to you about this on these on the calls, but let's look at the effect this is having on the bond market, because the bond market, again, everything that we're seeing out there, every analyst is not understanding why. Well, now we're understanding a little bit more of this. So we're looking at the 3.0 because that's what we looked at a lot before. It's down to it's probably the worst levels we've seen in 90 days. But it seems to every time they go in there, it starts to have a little bit of a positive movement from its bottom on the daily basis here. The other thing we're seeing is the 2.5 is also the 2.5 and the 2.0 are really putting pressure on the bonds, the interest rates to push them up. Look at the beating that the 2.5 has taken. Where it's nearly its lowest level again since let me see here. That's got to be since
last year.
Yeah, since last year. It's the lowest we've seen since COVID hit. This is when COVID on March 9th took over and started impacting our market. Now, what happened there? If you remember back then, those who were buying homes right then, there was a window of time. Locking was very, very difficult. We're having a difficult time pulling our locks at that point, and what ended up causing a lot of disruption and trying to find a place to place those loans, because who was going to buy it? Well, then a lot of aggregators stepped in and started buying when Fannie and Freddie weren't. So the market took care of itself. Right now, because of this mandate of the 7%, aggregators are taking a step back as well, wondering, do they get in? Do they pause? So what they're doing is they're pricing themselves a little bit away from real estate investors at the moment. So we are seeing interest rates go up as a knee-jerk reaction. I don't know exactly what is going to be the end result for rates with this, but this knee-jerk reaction is trying to slow it down while they're trying to figure out what do we have to do here. So what type of Scotty and I are seeing rates, high threes, low fours these days for your 30-year fixed, 20% down. And as far as I'm concerned, this is just my opinion. I'll let Scotty offer his here in a second, but this happening right now, that's tightening up for real estate investors. A lot of people jumped in the market because interest rates are so low. They were going to buy a house, become an investor because of low rates. They were acting like a consumer. This is an opportunity to shake those people out who are not investors. These people are getting ready to come play in a market. They thought, here's a different place to put my money, instead of becoming serious about this as a business. They're supposed to be the CEO of a real estate investment business, and they're not acting like that when they're freaking out right now. This is opportunity. This is what I say natural selection has literally been nullified by medicine, and personal responsibility has been nullified by legislation. So now what we have is a culling going on. You're going to have that natural selection, if you will, because it's going to get hard. And when it gets hard, the people who are weak walk away. When it gets hard, the strong people that are going to make a business of this and be successful at it, they dig in, and this is where opportunity is coming. What do you think, Scotty?
100%. And if you're shopping, you're buying, and you're out there and you're concerned about rates, all I can tell you is, like, Aaron and I will push everyone all the time to just do 20% down. It's still at 4.25%, 4.5%, 4.75%, cheapest money you're gonna find out there, closest to free. If rates a huge thing for you, consider putting 25% down. There's 25% down, you probably see 3/8, a half better in rate. So, if we're at 4.25% today, 4 3/8, by putting 25% down, you're looking at possibly 3.875, 3.99. I personally, if I was purchasing today, the 4.25%, 4.5% wouldn't bother me a bit. But there are those out there that, now that we've jumped in the fours and kind of got spoiled and, just started purchasing in the past year, and you got comfortable with these 3.499 or, wherever we were locking you, say 3-4 months ago, put 25% down.
Agreed. So and the thing is, these are not hard and fast rates. We're just throwing out differences, what we've seen recently, because each person's going to be different. Some people with lower credit scores will have a rate go higher. People with lower loan amounts or higher loan amounts will see a rate go higher or lower. So we can't necessarily quote these as the actual rates you're going to get. This is just kind of throwing out there. If you're seeing something in these rate ranges, you shouldn't be so damn concerned, because a year ago, I was still locking people in the 5s and in the 6s because of what was going on in the market. And if I told them I can get you in the 4s, Believe me, they've been making a mosaic of what you're seeing right here, me and Scotty, and putting us up on their mantle. Guarantee that, because they were getting something awesome. You're still getting something awesome. Anything under the rate of inflation, we know inflation's double digits. You're making money on that money. So let me share with you one more thing before we turn you guys loose. I know we're going to go long on this one because this is big. This is big information. Now, you've seen my amortization schedule we talked about with the time value of money, $100,000 property, $80,000 loan, $405 a month payment with $145,923 in principal and interest paid over 30 years. At even a 7% inflation, which is I'm showing here, when you recalculate this, you're not paying back the principal. You're not paying back the interest. You're not paying, you're paying less than all of it. You're paying right here. We can show $60,926.91 in actual dollar value because the way inflation is eroding the dollar. And we know inflation's on the rise. So you're not paying anything near what you're borrowing. Don't let rate freak you out. And want to know something that's really awesome about this number we just showed you? I'm basing this off 4.5%. I've always based it on 4.5%. Every time I've talked to anybody about this and showed this number, it's based on 4.5%. I've never give this calculation lower than that. And everybody still got excited because they didn't realize what rate I was quoting on. Let's look and see if it went to 5.5, what this would do. 5.5%, your payment goes up to $454. Big deal. You're going to raise rents and completely take care of that with 3% raise in rent. The next year is going to eliminate that. But look where your payoff goes. $68,274. You went up $7,000 ish, $8,000. Who cares? Over 30 years, $8,000 doesn't matter. That's at 5.5. What's 6.5 do to us? 6.5 takes to 76,000, still less than what you borrowed. You borrowed $80,000. So it does not matter what the interest rate is. And I don't see us getting to these levels. I'm going to go to 7.5, $84,000. You finally broke past $80,000. You finally paid more than what you borrowed when you hit 7.5. So if this doesn't help you understand how little it affects you, what the rate is, this doesn't factor in writing it off on your taxes. This doesn't factor in what's going to happen to you when you get to the compound growth in at least this number. It's not affecting you on your compound growth on your raising rents of 3%. A lot of different things out there that are helping you to become successful in this. The only thing that's going to stop your success, in my opinion, and I'm sure Sky's got the same one as you, you're going to block you. So if you want to get into a pattern of failure in real estate investing, walk away because the rates are going up. All you're going to do is make room for somebody else to jump in and take that opportunity from you. Any final words, Scotty?
No, I think you nailed it.
All right, brother. Well, I appreciate you taking the time this morning, getting up early to talk with our
Thanks
folks.
for having me.
We're going to punch this out, guys.
I got to get back on the front line.
Oh, yeah. Yeah, we're got to get on the phones. I'm going to be on the podcast circuit about this thing. We're going to gather more data. We're not done. This is just a quick look into what's happening. Don't stress about this. The market will work itself out. I'll keep you up on what's going on. You'll get more data from me. And again, interest rates, we don't know exactly where they're going to go, exactly what they are for you right now. We'll talk to you individually, quote you individually. Stay calm. You got professionals working with you. Thank you, guys.